No one ever voted for the interest rate on their mortgage. No referendum asked whether unelected technocrats should decide how trillions in money would flow, who would be rescued in a crisis, and who would be left to drown. Yet somewhere between inflation fears and financial panics, the loudest voice in our democracies grew quiet, and the quietest voice became decisive. This is the story of how power shifted without a bang, only a whisper. It's the story of when democracy died in silence. Welcome to Hidden Finance, where we uncover the secret architecture behind the money that builds or breaks our world. In this episode, we walk through the quiet revolution that reshaped modern power, the rise of independent central banks, and how their emergency tools became permanent levers. We'll trace the steps from gold to paper, from politics to technocracy, from elected budgets to bond markets. You'll hear how a promise to tame inflation became a license to rule in crises, and how those crises never really end. Stay with us as we decode the takeover nobody noticed until it was done. Money has always been political, but it wasn't always technocratic. In the 18th and 19th centuries, central banks like the Bank of England served merchants and monarchs, stabilizing war finance and keeping the machinery of credit from seizing. Their authority was powerful, but it was not independent. It was a tool of statecraft, bound to the priorities of empire. Across the Atlantic, the United States wrestled with this question through the first and second banks of the United States, only to abolish them under fierce democratic suspicion. The modern Federal Reserve wouldn't arrive until 1913, born from recurring financial panics and a promise to be the lender of last resort. The early 20th century forced central banks to navigate catastrophe. The Great Depression exposed their limits and mistakes, while the political wave that followed New Deal programs, war financing, and national mobilization put elected governments firmly in command of money and credit. After World War II, the Bretton Woods system anchored currencies to the US dollar and the dollar to gold, a compromise between fixed order and global growth. Central banks managed pegs and defended parities, but their missions were constrained by politics and international rules. It was a world where ministers, not monetary committees, made the decisive calls. That world fractured in 1971 when President Richard Nixon severed the dollar's tie to gold, closing the gold window and unmooring the global system. The 1970s delivered oil shocks, stagnation, and inflation that corroded savings and trust. Elected governments tried incomes policies, controls, and spending. All of it seemed to fail against the brute force of rising prices. The public lost patience with political promises that couldn't tame the cost of living. Faith needed a new anchor, and it would not come from the ballot box. In 1979, Paul Volcker took the helm of the Federal Reserve and raised interest rates to levels few thought tolerable. The medicine worked eventually. Inflation broke, but it exacted a price. Unemployment surged, factories closed, and a generation of workers bore the brunt of the cure. Out of that pain, a new idea emerged. Perhaps elected leaders should step back from money altogether. If price stability was too important to be left to politics, then let the central bank be independent, like a judge ruling dispassionately on the economy's fate. By the late 1980s, a template had formed. New Zealand rewrote the playbook in 1989, granting its central bank formal independence and a clear inflation target, complete with accountability mechanisms for missing it. The approach spread: make price stability the North Star, shield decisions from short-term politics, and professionalize the craft of monetary policy. This wasn't hidden, it was heralded as a triumph of good governance. The revolution was quiet not because it was secret, but because it felt so reasonable that few noticed what was being traded away. The 1990s locked in the new order. Britain granted the Bank of England operational independence in 1997, removing rate setting from the Treasury's hands. The Maastricht Treaty embedded independence into the DNA of the European Central Bank, designed in the image of Germany's disciplined Bundesbank and insulated from national politics. Across Latin America and beyond, central banks won stronger mandates after bouts of hyperinflation and fiscal chaos. The consensus was clear: stable prices would be delivered by technocrats, and politics would defer in matters of money. For nearly 2 decades, it seemed to work. Economists called it the Great Moderation: inflation low, growth steady, volatility subdued. Interest rates glided gently, and central bankers became stars. Some called one of them the maestro. Markets rose under their steady hand, and voters enjoyed calm seas without asking who really steered the ship. Independence was self-justifying because the weather was fair. Then came the storm. In 2008, the global financial system froze as mortgage securities imploded and trust evaporated. Central banks leapt beyond rate cuts into emergency lending with acronyms that sounded like a new language: facilities for commercial paper, dealer financing, asset-backed securities. The lender of last resort became the market of last resort, buying and backstopping assets no one else would touch. It was a rescue mission at wartime speed, and it made central bankers indispensable. With rates pinned at zero, they tried something bolder: quantitative easing, the large-scale purchase of government bonds and other securities. Balance sheets swelled by trillions as central banks hoovered up debt, pressing yields lower and nudging investors into riskier assets. The line between monetary and fiscal policy blurred as governments saw their borrowing costs collapse under a bear who never tired. It worked in the sense that deflation was avoided and markets stabilized. But the quiet bargain had shifted again. Technocrats now influenced not just prices, but the price of politics itself. Europe laid this bare. As sovereign debt yields spiked in 2010 and 2011, governments in Greece and Italy teetered. Letters from the European Central Bank urging reforms and budget measures arrived in Rome. And within months, Italy saw its elected prime minister replaced by a technocratic government. In Greece, a former central banker was brought in to lead under crisis conditions. Then in 2012, the ECB's president calmed the panic with 3 words: whatever it takes. The promise was unconditional in tone, but the programs that followed were conditional in substance. Support would come if states accepted strict rules. Behind the scenes, the dollar became the world's emergency oxygen. The Federal Reserve extended dollar swap lines to major central banks so they could funnel liquidity to their own financial systems, turning the Fed into a global backstop. When the Fed hinted in 2013 that the tide of asset purchases might ebb, the so-called taper tantrum borrowing costs jumped and emerging markets buckled. Monetary policy in Washington rippled through Jakarta, Johannesburg, and Sao Paulo. Independence in one capital became dependence in another. The pandemic completed the transformation. In March 2020, as markets plunged and economies shut down, central banks moved within days to buy government bonds, corporate debt, even exchange-traded funds in some jurisdictions. In the United States, special facilities promised to support Main Street loans and municipal bonds while corporate borrowing exploded at rock-bottom rates. In Europe, a pandemic emergency purchase program gave the ECB unusual flexibility in what, when, and where to buy. The tools were extraordinary, and so was the discretion that came with them. The consequences were profound, and not just for balance sheets. Asset prices soared under years of low rates and rapid liquidity, widening gaps between those who own assets and those who don't. Housing costs, turbocharged by cheap mortgages, outpaced wages in many cities, turning shelter into a lever of inequality. Markets learned to expect a backstop, the fabled central bank put, and took more risk in the shadow of that safety net. By the time inflation returned in 2021 and 2022, years of accumulated distortions stood in the way of a clean exit. When inflation did catch, central banks slammed on the brakes with the fastest rate hikes in for decades. The cure was familiar: make money dearer, slow demand, and squeeze price pressures out of the system. But the pain fell unevenly on borrowers, on first-time homebuyers, on leveraged companies, and it carried political edge. Budgets that had seemed generous suddenly faced higher debt service, compressing what elected leaders could do without angering bond markets. Ballots still counted, but basis points bit harder. Democracy didn't disappear, it was reweighted. Voters could choose their leaders, but not the instruments those leaders had ceded to independent boards with statutory mandates. Legislatures still set taxes and spending, yet the cost of those choices was governed by a body whose legitimacy rests on expertise, not elections. Oversight exists: hearings, reports, audits. But the critical judgments are made in real time and in secret deliberations, then announced as fait accompli. The system was built to protect the public from politicians. It also protected policy from the public. Defenders of this order argue, with reason, that independence is a shield against short-termism and runaway inflation. They note that central banks operate under laws passed by elected parliaments and can be reined in by those same hands. Yet mandates have crept broader financial stability, employment, climate risk, and the tools bite more deeply than textbooks once imagined. In a crisis, urgency outpaces oversight. The emergency powers arrive first and the accountability often follows much later. It's not a conspiracy, but it is a concentration of power unlike anything modern democracies initially envisioned. Now a new frontier looms: the architecture of money itself. Experiments in central bank digital currencies, from the Bahamas to China, from Sweden's e-krona pilots to the European Central Bank's digital euro investigation, hint at a future where public money becomes programmable and payments live inside official rails. Advocates see resilience, inclusion, and lower costs. Critics see surveillance risks and a state foothold in retail money. Stablecoins, crypto markets, and private payment giants add another layer to the contest over who controls the plumbing of everyday transactions. The direction we choose will say as much about democracy as it does about technology. So what do we do with power that's both necessary and unaccountable? Some propose periodic reauthorization of central bank mandates so that independence is renewed rather than assumed. Others call for stronger transparency, clear rules for emergency action, and sharper boundaries between fiscal and monetary roles. There are ideas for citizen panels, public interest reports, and more explicit distributional impact statements before major decisions. None of these would solve every problem, but all of them would restore something that slipped away: the sense that the public's money belongs to the public. A century ago, the challenge was building central banks that could stop panics. In our century, the challenge is ensuring that the cure for crisis doesn't become the quiet end of consent. The takeover wasn't a coup, and it wasn't malevolent. It was 1,000 reasonable decisions made in the name of stability. But stability is not the same as legitimacy, and price stability is not the only thing that makes a society worth living in. In the shadow of expert rule, citizens have the right to ask not only does it work, but who decides and why? Power didn't roar when it moved, it whispered. In democracies, the loudest noise isn't the crash of markets, it's the silence when decisions that shape our lives are made without us. This is Hidden Finance. If you felt the echo of that silence, stay with us. Subscribe for the stories beneath the headlines, follow us on Facebook for the threads that tie policy to your paycheck, and share this with someone who thinks money is just numbers on a screen. The forces we've explored tonight are still at work, often unseen, always consequential. We'll keep tracing them, one hidden lever at a time. Until next time, this is Hidden Finance, where the economy finally makes sense.